So Softchoice, symbol SFTC on the TSX, provides IT solutions ranging from implementation to management of IT environments. So these are things like cloud database management, hardware lifecycle management to cybersecurity, anything really in that area they operate in. The company operates in Canada and the US. Softchoice breaks down its services into a bit more manageable segments of software and cloud, services, and hardware. The company does as well have notable partnerships with Microsoft, Google, and Amazon, with the big one being Microsoft there, but they have partnerships with all the big cloud hyperscalers. Softchoice currently pays a dividend yield of 2.8%. Like we said, the company IPO'd on the TSX in May of 2021 at a share price of $20 and has since fallen to the current price of $18.72 over the past 3.5 or so years. However, it is actually up quite a bit year to date, up 20%. As well, it paid a significant special dividend of $4 during the year. You can see when they did, and when it actually got paid at the ex-dividend date, it went up $4, then went down $4, exactly by that minus a few cents effectively. So far, though, good return this year. You get $4 special dividend plus some share appreciation of $3.35. First, can look at a high-level long-term financial view. On a per-share basis, revenue has been declining over the past few years. You can see that in the light blue on the left graph. And although choppy, EPS has generally improved since the IPO or the re-IPO. The company does have some seasonality, with Q4 and Q2 being stronger due to customer year ends, primarily in Q4, but as well as Q2, as that's Microsoft's fiscal Q4 being aligned with Softchoice's fiscal Q2. And as Microsoft-related sales account for 29% of net sales, it's a big player for Softchoice. Prior to the special $4 special dividend, the company did have a declining net debt position, but with the dividend being primarily funded by debt, the company now actually has a higher debt load. This is something that we don't generally like to see under a long-term hold view, as issuing debt to pay a dividend decreases the value of the company after the ex-dividend date, as you will no longer receive the dividend, but you're bearing the weight of the debt. So really, it's that trade-off is gone. If you've missed that ex-dividend date, you're losing value at that time. So moving on to the Q2 financials, with the figures being in US dollars, the company saw a 7% decline in net sales to $193 million. However, it did have a strong revenue retention rate of 100% for its recurring services. And a gross profit did actually increase by 12%, largely due to improved margin in the software and cloud segment, increasing the margin of 73% from 70%. Additionally, services improved, offset by a lower hardware gross profit. But the story of the business that really drives the financials is that software and cloud, and we can see that segment is doing well and is driving the profitability. Moving down the income statement, operating profit increased by 16% to $22 million, powered really by that increased gross profit, offset by slightly higher SG&A. However, further down, we can see a rise in non-operating costs, primarily those finance costs, substantially increased to $4.8 million. From an income of $1.1 million. Last year, the income was driven by foreign exchange. So that's really out of management control. That's something you just have to observe. You have to realize it, but it's not going to be something recurring, and it will fluctuate quarter to quarter, year over year. It's just something you have to take as it is. However, the change that is under management control to a degree is those finance costs, primarily interest expense on the revolver that they had increased to pay that dividend. The interest expense is now at $5.8 million from $3.5 million, offsets $2.3 million of that $3 million operating profit increase. You can link that to that dividend earlier. So operating profit is actually down because they paid that dividend, and that's right there in the financial cost. The revolver now is at $194 million, up from only $39 million at the start of last year. Ultimately, this has resulted in net income falling about 14% to $12 million and diluted EPS to 20 cents. Moving to the balance sheet, like I said, the company has a net debt position of $190 million, primarily composed of that revolver that saw an update due to that special dividend. The company has a net debt to EBITDA leverage ratio of 2.3 times. As well, the company does actually have a lower current ratio of only 0.8 times due to the higher trade payables compared to lower receivables over time. It's been the trend of payables still ticking up almost on a quarterly basis, while receivables has slowly went down. And further, another sign of a bit of a concern on my part, it's not the end of the world by any means, but the company has already engaged in receivable financing for 12 million of its receivables at about a 1.5% discount. This is generally not optimal, as you are receiving less cash at the end of the day, and it means that you need to top up your working capital. That's normally the sign that it gives when you are doing receivable financing. It's not something which you generally want to elect into. It's more by force, even though they do have some financing wiggle room there with their revolver, having about, I think it's another 160 million in room. They have actually opted for receivable financing already. Looking at the valuation, the stock trades at a gap PE of 22 times, a price to free cash flow, removing the impact of working capital of 20 times, and an EV EBITDA of 12 times. I wouldn't consider the company to be cheap, even being a software-oriented company, as the growth and the risks don't really support any premium valuation. If anything, they support a discount valuation at this time. So moving forward, or concluding, I should say, the company is profitable and is growing slowly at a choppy rate, but it has not been really a particularly high overall growth rate for the past year. Net sales on a per share basis has been declining. EPS is ultimately more important than just pure sales, but at a point you do need to support EPS growth with some sort of revenue growth, especially on a per share basis, as you can only get so much margin. You have that limit of 100% margin theoretically, and you at that point would need revenue growth. I don't like the issuing of the special dividend that is supported almost purely by borrowing or debt. There are times to do special dividends, but in my opinion, if debt is required, it lowers the long-term value of the company almost all the ways. Further, the company has had to conduct that receivable finance, which can be another worry given the financials not poor but not great current ratio, driven by the trade receivables and payables, which could, if they need to, they would probably likely draw on that receivable, but that then further causes higher interest expense, which they, of course, would benefit from a lower interest rate environment, which might be why they're seeing this as an opportune time to do these sorts of things. But ultimately, even if interest rates are lower, you're seeing a drag on the company from interest expense if you are taking on either more revolver, if you do have to issue a long-term debt note in some sort. It does create a drag on net income. Lastly, the valuation metrics are not overly appealing given the growth and the risk at this time. This is something which I'd really just monitor at this time if they do change up a bit. I don't really like those special dividend issues, which some companies and investors do, but that's not something which I would like to see, as I do view it as lowering the long-term value of the actual company, not just the returns of the company. It actually can impair operations at the end of the day.
Yeah, and again, I echo the statements on the special dividend. It seems like a payment to shareholders, basically not in the best interest. A one-time payment, maybe to management, not in the best interest of long-term shareholders when you go to a significant net debt position. Then, so it doesn't make a lot of sense. It impacted EPS, which impact the company's quarter, which impact valuations on the stock. So robbing Peter to pay Paul. It doesn't make much sense to me.
Yeah, on that, like the debt leverage isn't absurdly high. 2.3 times off standard EBITDA isn't absurdly high by any means, but it is the reason why they got to that point, which is the
Yeah.
concern.
Yeah.
And you can see
And
right in that.
did
Go
you
ahead.
not have better places to grow to put your capital is the other question. Could you not have made an acquisition, create something yourself internally to grow organically? What was the impetus to pay that dividend out at that point? That is, to me, a bit strange.
Exactly. It's really, to me, when I see that, it's borrowing from the equity's future and you're
Yeah.
paying it right
Yeah.
now.
Yeah.
So if you can't really achieve that growth, like Ryan was saying, that's the only way it would make sense mathematically, is if you were expecting lower growth than what your weighted average cost of capital would be.
Exactly. Yeah. No.